Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pargamanik. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, contact your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance.
Awesome.
You guys have the disclaimer there. And let me share my screen. If you guys are joining us for the first time, Will and I, we do this show in the mornings to help answer any questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on a show and ask your question live, we provide a link to Zoom on that live chat on YouTube. Click on that, takes you over to Zoom. Once you're in Zoom, click on that button that says raise your hand at the bottom of your screen. It'll ask you if you want to turn on your video camera. You don't have to turn on your video camera. Once we let you in, you can ask your question live. If you prefer to type in your question, you can type that question on the live chat on YouTube. Will's watching it. He'll read the questions back to me. And while we're waiting for more people to join and those questions to come in, we'll start out taking a look at the pre-market report, see if we could get some insights about stocks that are trading in the pre-market hours. And afterwards, we'll take a look at the questions. If you guys don't have any questions, I might just continue on the same topic we we're talking about last week. We're trying to price out SPY. We started to create a simple model. So I'll continue on that. I did get some questions regarding that model after the show. So again, I'm going to try to take the questions first. If we don't have any coming in, we'll just continue on the same discussion from Friday.
All right.
Okay, so, pre-market report. These are stocks trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 66 stocks made our percentage gainers list, 41 on the decliners. So from this perspective, looks like we're setting up for bullish bias at the open. If you look at the list, you will see that this list has stocks that are low cap stocks. It will have ETFs in there, leverage products, closed-end funds, pretty much any security that is listed on the major U.S. exchanges. If it's trading in the pre-market hours and meets our threshold, it could make this list. And what we want to do is narrow down this list to a smaller group of stocks, see if we could get a little bit better insights or more focused insights. And what we'll do is use the filters up top to help us with that. And this filter here in ETF, I'm going to use that. Click on it. You get a drop down of ETFs to choose from. The top three are broad-based ETFs. Then you got some sector ETFs here, but let's choose SPY. That's the S&P 500 ETF. Click on that. And the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see 6 stocks made our percentage gainers list, 7 on the decliners. Like really a mixed bag at the open here. Couple ones that stick out. I know now there's kind of a lot of news and enthusiasm around AI. And you can see here Microsoft up 1.7% today, Google down 4%, and that it's becoming right now almost a competition between these two big, massive firms. Who's gonna, win out on this AI technology? Because now you got Bing invested into the ChatGPT. They're gonna start, using that in their search engine, integrating it with other Microsoft products. So it's not going to be just on the search. They're really taking that technology, working hard and enhancing their, the suite of other products and services that they have. Google, right now has the lion's share on search around the world. And, and now it's starting to look like this AI technology is becoming a serious, competitor against what they're doing. So it's a story, that's really developing, but definitely a lot of enthusiasm around this, the new technology, artificial intelligence. And I did read an interesting article on Bloomberg today. It's up here. I left it here. So this is the ChatGPT. And we talked about it a little bit, how even we started to try to use that technology to see if we could improve our own productivity as a business using ChatGPT. But here's an interesting article in a use case in finance where they did a test on taking headlines from the Fed, taking headlines from press releases, inputting it into the ChatGPT and asking it, to interpret that language and give its opinion if it's positive or negative regarding, the impact on stock prices. So in the case of Fed, if it's giving hawkish or dovish signals, or they even had a instance that they just took a headline from a press release with a lawsuit, I believe. I'm going to come down here, maybe show you guys some examples. And these are things that a lot of hedge funds internally have been doing by taking, releases, government releases, press releases, and internally tagging headlines or the language, if it's positive or negative for the stock price. But it looks like the ChatGPT itself is doing such a good job that you may not even have to do that as a hedge fund anymore. You could just feed it right through that ChatGPT. And here they had, ChatGPT decipher Fed speak. And they had people from the Fed actually look at this model, and you could see, and you could read more about it here, that it was really good at classifying and interpreting the Fed itself. Is it sending a hawkish or dovish signal from the language that, that it puts out? So again, it's taking the language and making an interpretation for you. I think, let me just take another, they gave some examples, here's a statement here. Labor market conditions have shown some improvement in recent months on balance, but the unemployment rate remains elevated. So it took that sentence and, it gave an interpretation. Let me see here. I believe right there that's the Fed being dovish, regarding using that statement. Let me take a look at another one here. And these are interesting because I think that the AI itself is going to be a really big story going forward, and we are going to see a lot of use cases for it. So it's good to just stay on top of, what people are experimenting with and what are potential use cases. Here's another one that they fed through. Rimini Street fined $630,000 in case against Oracle, and that was interpreted. They asked, is this good or bad for Oracle? And ChatGPT said it was positive, and then explained why. It could boost investor confidence in Oracle's ability to protect its intellectual property. So there you go. One giving you some use cases in finance how ChatGPT can be applied. So I just wanted to bring that up, give a chance for some questions to come in. Well, let me know.
It is amazing the speed at which this AI is hitting, not just ChatGPT, but all sorts of different artificial intelligence features. My brother, who was the first one who mentioned ChatGPT to me, and something happened, I guess, towards the end of last week, over the weekend, where some new AI platform that allows you to grab sources of music all over the internet and create your own music.
Oh, wow.
And someone, and they don't know who, created a video that's had over 10 million downloads, or excuse me, a song, a rap song that has over 10 million downloads. Wow. And he copied different artists mixed their voices, and the ChatGPT created, or something like ChatGPT created the lyrics.
An AI, right, that created the lyrics.
And so, this, who owns it, there are all these, and it sounds a lot like, I guess, a mixture between two famous rappers.
I got you.
So
right.
It's really interesting. And, I was reading something this morning. I mean, really, AI is going to affect both positively and negatively probably everyone's businesses, lives, everything, more and more rapidly as we go forward.
Yeah, no, for sure. It's you could see, feeding it, you give it statements, you give it questions, and how quickly it turns around. It's pretty remarkable, that it is able to do that. And you got to imagine, it's not only that, it's remarkable how fast that it could compute, because you have to hit the database and have very good indexing, in place to be able to go in or analyze it and give you an output that fast. So definitely the technology is, it's unbelievable. It's one of those things where, we go through different, technological growth phases, and sometimes you see a technology, it's great, but sometimes you're like really blown away by something, like, like when the first like iPhone, smartphone came out, or I remember like when the internet, like, being able to connect to things or see videos over the internet. And this is like kind of one of those where you feel like, whoa, that's amazing that it could do this, So
well,
very
you're starting to see videos and that have actors and actresses in. Yeah. And they're actually created by a computer model, a computer program. Yeah. You wonder, I mean, I saw a ad for cars this weekend. I couldn't tell, it almost looked fake, like it was created, like the actors and the actresses were not human beings. I mean, they were so perfect. You wonder what's going to happen if you're an actor or an actress going forward, and not, someone everyone knows,
Well, and I think, like you said, there are going to be issues, and even these big tech firms are now calling for regulation. I think Google's even calling for regulation. Where, and some of the even lawmakers, I think, started to talk about like deep fakes. Where these, you could have technologies to create videos of people saying things or doing things that they never did, right? And it could be a deep fake and put people into a position where they're defending themselves, saying, well, no, I didn't do, can you make like, porn movies or some with people's faces and make it look like they're really in it? Who knows what or saying things they never said. and make videos with it that look real, and maybe it's very hard to even figure out what's real or what's not real. And those could be issues going forward, because these technologies are that good, or potentially can be that good, that you don't. I think even Elon Musk was one of the people saying that he's trying to, combat these bots, or he's going to go down trying to combat these bots, to detect them and get rid of them on Twitter, right? Because he thinks that there are a lot of just these AI bots putting out content there that seem like a person or legitimate is creating them, but they could be just AIs generating these tweets. So one of the things he's trying to do is actually detect this activity, and block it, right? Especially if you could use it in a way that's trying to manipulate, or in a way that's trying to do things in a bad behavior way.
Yeah, it's really interesting.
So let me come back. If there are no questions, we'll just move on to SPY. Kind of continue on the last Friday's discussion.
Perfect.
All right. So we're using SPY as an example. I'm going to come back to this valuation model. And when we look at stock prices, as a financial analyst, practitioner, trader, you're trying to take the price and put it through a model to get some kind of an answer to a question you may have. And because yes, we know what the price is, but the price itself is a signal. It's conveying trader and investors' expectation of something in the future, right? Because it's a forward-looking. It's a forward-looking instrument, and so we started to create our simple model. And you have to start simple, and then you're going to tweak it and grow it. So we discussed, what's embedded in this price, and you guys could go back and look at it, but basically you said, okay, what's important? We took the most important factors and variables that impact the stock price. And the two most important, earnings and where the interest rates are. Okay. So earnings, you're investing in something today because you think that you're going to get more money back in the future from your investment. And earnings is a key driver of that. In addition to it, we were talking about, you got to compare it to the risk-free rate, because you're foregoing buying a U.S. Treasury that's guaranteed by the U.S. government. So, it's considered that it doesn't have default risk. So we consider that the risk-free rate. So you're foregoing that risk-free rate to invest in something risky. So if you're doing that, you should be receiving some risk premium. Okay. So we identified that the earnings yield, that's how we started out. We took the operating profits and we said, okay, well, we know what the trailing 12 months earnings are, and we know what the enterprise value is of these stocks. So since we know that information, we could calculate the trailing 12 months earnings yield. That's this. Okay, that's our starting point. So right now, the operating yield on SPY, going through the whole calculation, is 5.37%. So when we talk about earnings yield, there are different earnings you could use. I prefer, at least in this model, the operating profits, which are profits coming from the core operations, from their core business. So then we could compare that to and I use the 5-year treasury. So when we look at the risk-free rate, there was a question actually like, well, which one do you use? Do you use the Fed funds rate? Do you use a longer term rate? Is it 5-year, 10-year, 2-year? So I don't think that there's an exact right answer. I will say that a lot of times you have the 10-year reference, so analysts will reference the 10-year. And the reason behind it is that there's another component to this, and that's the assumed earnings growth. So when you invest in a stock, you're looking at the trailing 12 months as kind of a starting point, but what you're trying to do is figure out, well, historically earnings did not just stay the same. It's not flat, and they move around, and over time they grow. So if you're going to hold the stock market, and if you purchase it at today's price and you expect earnings to grow by a certain percentage year over year, then we could calculate what we call it like the forward yield, right? So let's say if you hold it for 5 years and the earnings are going to grow year over a 5-year period, what is the average earnings yield? And that's one of the hardest things to forecast. We talked about it's almost impossible to do it even a quarter over quarter. So even if I have the most latest data, right, what they earn today, and I have all this data to analyze, and I could analyze new data from day to day every day, it's hard to predict what the next quarter will be. We could see analysts, sometimes they're, they'll beat, they'll miss, sometimes they'll get it in line, sometimes it's way out of line, but it's really hard to predict. And the earnings are very volatile. If you take a look at quarter to quarter or even year over year, they're very, very volatile. And here's an example. This here is a stretch of 5 years. So every point is going back five years and taking the average annual growth rate. So you could even see here, maybe it was a little bit steady, fell drastically here over COVID. Then we got the stimulus, went up really fast. It's coming down. And this is a 5-year, looking over a 5-year horizon. So what happens is analysts will go out further and further in time to try to smooth out those averages, right? So 10 years will smooth it out even more, right? You smooth out those volatilities, because then you'll get an average of those. So you can see here in the 5 years, so far the median growth rate was 4.7%, average 6.4, but that's the average. The most recent is 9.4, right? Because we're still coming off that stimulus. So the yield, though, but this yield here, the one you use, if we take our estimated forward yield and we use the 5-year treasury, then we could calculate, well, what is the difference? And the difference of those will be our premium, or equity yield premium, right? So if you're expecting over the next 5 years, year over year, to earn 6.5% in earnings, and the 5-year treasury is 3.6, so you're earning, the equities are earning 2.9% on average. That's our predicted model, on average 2.9% over the risk-free rate. We could use the 10-year treasury, it'll give us a different one. We could use the Fed funds, and it's hard to exactly say, especially when you have an inverted yield curve, because when you have an inverted yield curve, well, what happens is that the Fed funds rate is higher than the 10-year. And, so what is your required risk premium, right? If we use the 10-year, it'll look like the equity risk premium is better. But the Fed funds rate also is important because you don't need to go in the 10-year. Investors could put their funds into the 1 month, 2 year. If it's a better yield, if you think it's a better yield, you don't have to go into the 10-year. You can go into the 2-year, you can go into the 5-year, you could go into the 1 year, especially if it's a substantially better yield. You could go to the shorter term. In addition to it is that a lot of short-term borrowing is based on the Fed funds rate. So, corporations can issue long-term bonds, but commercial paper is usually short-term, right? Commercial paper is usually like a revolving credit, or you got in the money market, it's like less than a year. So those costs, the cost of capital, those are going to reference the short-term yields. So when we have this inverted yield curve right now, it's very hard to say, well, what is the risk premium, that the market is giving, because the short-term yields are inverted. They're much higher, and they're going to impact the economy. So another reason, I stuck right now with the 5-year is the following. You want to, when you price a stock, you want to give it, well, what is my required risk premium? How much do I require above the risk-free rate, right? Because you want to say, well, if I require, so here's where the stock is now. If the risk premium right now is 2.9%, and I require 4%, well, then the stock should be at 300, all right? If I require 3.5%, well, then the stock is 341. Maybe I require 1%, then it's 1,095. So figuring out the required risk premium is kind of like up to you. So the reason I use the 5-year is that there are certain places I could reference that can help me out. And not exactly the 5-year, but somewhere in between. And one of them is, well, if the cost of hedging my equities, hedging my downside is increasing, then I want to increase the risk premium, right? If it's decreasing, if I could buy insurance cheaply, then maybe I'll require a lower risk premium. So the idea there is that, well, if I'm trying to see by my assumptions if it's undervalued or overvalued, and I'm looking, out, I don't know how much it's going to cost me to hedge 10 years out. There's nothing really there to help me out with that. And nothing really 5 years out. But if I look at, let's say, an SPY, how far out do we go? December 19th, 2025, right? So that's over 2 years. So I could figure out, well, how much would it cost me to hedge on an annual basis, at least going out this way, to help me out a little bit, as one of the inputs, not the only one, but as one of the inputs to start helping me build my model. How much risk premium should I price in? Because if it costs me zero, right? If it costs me zero to hedge my downside risk, well, then I don't need as much risk premium, right? Because I could just buy, somebody's going to give me insurance for free, and then I know, like, if the market goes down, I'm hedged and I'm not going to lose. Then I'll require much less premium. But if it costs me a lot of money to hedge my downside risk, then I might require a larger risk premium. Okay, so again, I'm starting simple, And as we build this model up, you guys will see that, there are certain reasons where you have to compromise and say where, which data should I reference? What other data points can help me out to build my model and help me price this, asset class out.
Awesome,
Right.
awesome job, D. We're right up against the open. And Rob did ask, is this a new feature? And I think this is all on your internal, right? You're still testing all this information.
This is all, this is still all on my internal. I'm trying to build it out in a way that when I push it out, kind of it's a little bit more intuitive to you guys, because I'm using calculators on calculators about, so even if I pushed out what I have, I don't think anybody would be able to use it except for me, because I'm the only one who kind of knows where everything is and how to tie it together. So I'm trying to build it out in a way where, look, this is a proprietary model, right? It's not something you're going to go out there and pick up. Maybe you'll pick up some of these points, but eventually it's going to be a model that I'm pushing out that you're not going to be able to find anywhere else. And I'm trying to do it in a way where it's intuitive, but it's a balance between, what do I show, what I don't show, and how many parameters do I push out that you could start using, it's useful, and then try to build on top of it. Because eventually you're going to, once you get to know how to use this, I guarantee you're going to be like, okay, bring in more parameters, bring in more data, bring more information. Even this part alone, earnings growth. If I just we're just talking about this component. Each of these components has its own analysis.
All right, buddy. Awesome way to start the week. Thanks so much, my friend.
Everyone, stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Great in peace, my friends. Have a great day, D. We'll talk later. Bye.